بسم الله الرحمن الرحيم. الحمد لله رب العالمين، والصلاة والسلام على أشرف المرسلين سيدنا محمد وعلى آله وصحبه أجمعين. Dear brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuh. The Islamic Research and Training Institute is pleased today to have Dr. Turqan Ali Abdul Manaf to present his research finding. The title of the presentation is Measuring Systemic Risk, Empirical Evidence from the Malaysian Dual Banking System. First, let me introduce Dr. Turqan briefly. He is currently a senior economist in the research division of RT. Before he joined RT, he was an associate professor in the International Islamic University of Malaysia. He got his Bachelor of Engineering from Dolan University of Technology in China, and he
You have entered a
paper is Measuring Systemic Risk, Empirical Evidence from the Malaysian Banking System. This actually is a part of a research project, still in the very preliminary stage, but I'm happy to present whatever I have so far found from these studies. My presentation is about 5 parts, from introduction, literature review, methodology, and some of the results, plus some tentative conclusions. First, let's see, have some introduction about the topics. Something wrong with my. As all of us know, the 2007-2008 global financial crisis have had a lot of impact on the US economy, of course, to the global level. Let's see some of the figures. So, taking the stock market as example, after the financial crisis or during the financial crisis, from 2008 to 2009, the USA stock market dropped by 46%, UK by 49%, Europe 35%, and Japan about 50%. So this is a dramatic drops in the stock market. And in terms of real economy, you can see from this figure, USA in 2008 the growth rate is negative 0.02%, but in 2009 it became negative 3.5%, a big drop. And UK from negative 1.1% to negative 4.3%. Japan from 1.17% to 6.29%. Finally, to my country, from 9.6% to 9.2%. Some of you may think this is already enough, but you see the base is what, more than 10%. From 12 to 14% to 9.6% is also what, a big drop. So from this one we can see the financial crisis really not influence the financial market, but also what, the real market. So this financial crisis Also, sometimes we call it what systematic risk. If this financial crisis not only affecting one sector but to the whole system, then we call it what? Financial crisis or systemic risk. And from this table, the previous slide, we can see that what? The financial crisis are not a single event, but this one can affect what? The whole system. It means all the financial or real economies are interconnected. And also, this financial crisis also shows us how fragile the financial system is. If something happened to one market, it can have what? Influence on the entire domestic and global economies. So that's why all of us know before the financial crisis, the Basel I and Basel II, they just care about the individual institution what? Capitals. As long as you have enough capital to caution against the unexpected loss, they are fine. But this financial crisis, okay, financial crisis find what? This is not enough. Because before that, all the regulations, they only care about the idiosyncratic risk. It means what individual risk, and never consider what happened to one institution, the impact on the whole system or other firms. But the global financial crisis highlighted the importance of going beyond the individual risk to the overall risk, so-called systemic risk. How to identify, how to determine, how to quantify this risk become tremendous important. So this research, this paper, what happened to my, sorry. So this this financial crisis also lets us know that what risk in the financial system is not only the individual risk, not like what credit risk, or not about what operation risk, not about what other risk. It could be more than this. So we call systematic risk. Systemic risk, sorry. So that's why the regulation should move from individual institutional regulation to the whole system, or from micro to macro prudential regulation. So that's why I see what after this financial crisis, there are a lot of practitioners, academias, everybody was. They are now focusing more on the detecting and what managing systematic risk. Of course, there are many studies have done after this financial crisis in the attempt to what we call attempt to quantify, or maybe even defining the systemic risk. Actually, what still ongoing process. But anyway, we are trying to, based on the previous study, to do our research, because what even there are many studies done, and of course most of the study done are maybe Europe area, US, or maybe in global perspective, but not many study on what individual markets, and especially what when the market have both Islamic and what conventional banks. So that's why the purpose of this research paper is try to study the Malaysian banking sector, which is what all of us know. They have Islamic banks, and also they have what conventional banks. I think this gives us a very nice platform to study how the Islamic bank and the conventional bank react to this what systemic risk. To doing so, we are trying to study the sector from 4 key areas. One is what we want to know how risky is individual banks in isolation. We are talking lending commercial and what Islamic bank together. We also want to find out to what extent each bank will contribute to the systemic risk. And also we want to know how the bank are linked among each other. Finally, we try to know, based on this result, is there any possibility for us to have some regulation what use. So that's our objective. And now let's see about the literature. As I just mentioned, okay, even there are so many studies have done on this topic, but there are still a lot of what uncertainty, what we call unclearness about what is systemic risk. Somebody asking me, so what's the difference between systemic and what systematic? Okay, we know the systematic is what the risk, which is what can be eliminated through diversification, but systemic risk is not that kind of risk. This is called what the overall market, the whole market, which is what unable to be what eliminated or avoided by diversification. So there are many actually what definition about the risk. So for example, this BIS in '94, they are given a definition. It's the risk that failure of one bank to meet its contractual obligation may in turn cause another bank to default with a chain reaction leading to broader financial difficulties. Another one is what this Barcelona and one in '95. Sorry, something wrong with my. And so you can see actually what these three definitions actually trying talking about. This systemic is what? It's a kind of what interconnectedness between the banks, okay, or a financial institution. If one institution having problem, it may create a huge impact on the whole system. But the more maybe what the most relevant and encompassing definition actually come from what the joint paper by the IMF, BIS, and World Financial Stability Board in 2009 after the financial crisis. They define the systemic risk as a disruption to financial service that is caused by impairment of all or part of the financial system and have the potential to have significant negative consequence for the real economy. So actually our study actually based on this definition, okay, this definition. So of course, the criteria can be what can have a size, interconnectedness, and what complexity, leverage, liquidity risk. Everything can be what taken into consideration in this definition. So any part of the system have problem, it will be what trigger the whole system or another bigger a portion of financial system get in trouble. So this we call. And of course, there are also people argue, okay, this definition does not differentiate between the event that is systematically important and what an event is a systematically relevant. Okay, so but we are not interested on this kind because I just want to see this definition still ongoing. There is no any perfect definition about what is systematic risk. Given the definition of systematic risk, let's say, because in our research, our purpose is to quantify this systematic risk. So how to quantify? Of course, there are many what papers actually published in how to quantify this risk. And of course, you can from they can quantify through institutional level. They also can quantify through what aggregate level. But in our study, we are trying to quantify the systemic risk from individual institution level. So if you want to know, there are how many ways, actually there are more than 30 techniques try to quantify the systemic risk. If you read the Biosource Flow Law and Valawanis 2010, these people give you a fantastic review or survey about all kind of tactics available. So I'm not going to review all because it takes a long time. What relevant for us is actually what? There are three: conditional value at risk approach, or marginal expected shortfall, MES, or systemic risk index. Actually, the 3 is what? 1 based on 1. Okay, so but today in my paper, I just want to show you the first approach, and the second approach and third approach maybe later, not today. Okay, not today. Of course, there are many empirical research I've done on this topic. So you can also see from, for example, someone did on the Thailand financial market, and also Lopez Espinosa did for what? For many countries, for 54 international financial institutions, and Grady and Ingun actually was this used a lot, modified this covariance approach done on certain Islamic banks. Okay, banks, and of course the result is very different from one another. So you can, because what, due to the different approach, different data set, the result is not really what, unified. Okay, unified. Okay, now let me spend a few minutes discuss how we quantify the risk. Okay, let's actually in this case, okay, I'm using this Adron-Bronimer approach we call COVA, okay, conditional value at risk. This is actually initially developed in 2008, then improved again in 2011. Finally, this paper was published in Economic Review in 2016. That's why I put 3 years. But basically, the core paper actually we are using 2011. Okay, because 2011 and 2008 is what, a little bit different. I can show you what's the difference. Okay, so what's the idea behind it? Okay, and all of us know what's value at risk. Okay, value at risk. Okay, so the maximum loss institution can lose when in what, in worst condition, right? Maybe in certain level of scenario. So this here, this was this E and R. They use this concept to extend this one to financial system. For example, the financial system as a whole system, they have what, value at risk. The value at risk of the financial system depend on the individual institutions condition. If one of the individual institution have a trouble, definitely it will also affect the whole system by large or by less, am I right? But different institutions, they may have different impact on the financial institution. So his idea is very simple. Okay, with all financial institutions are in normal state, no more crisis or no distress, what is the value at risk of the financial system? And what is the value at risk of the financial system when one or two of the individual financial institutions are in distress? The difference between these two we call delta covariance or value at risk. That one actually what is, we define that one as the individual financial institutions what contribution to the overall systematic risk. Okay, so and they have a lot of benefits by using this approach, because what, we can measure the risk of individual institution, we can measure the risk of the overall system, we can also measure the marginal contribution of individual institution to the overall system. And also we can what, incorporate other macro factors in estimating this risk. Okay, so how we, this is actually what, a mathematical definition of what is called core VAR and what, delta core VAR. Okay, VAR. This core in here means what, conditional, co-moment, or condition. Okay, condition. And so the first equation talking about what is the value at risk for individual institution. The second is actually what, we extend this one to the system. The third one actually what is a definition of what, so-called the individual institution contribution to the overall system. Okay, our system. I'm seeing I no need to read one by one, right? Because it's very mathematical. Okay. So given this concept, okay, given this concept, how to measure it or how to estimate? Okay, there are many ways to estimate, but I use we call the quantile regression. Okay, QR of this what Bassett in 1978. The reason why I use this one because this method does not require the on the data set because you know the stock market price normally they have all kind of problems, but this quantile regression have a less problem when using this kind of data. So we run the first equation, get the alpha, beta, and beta the head, okay, alpha head and what beta head, and then we use these two coefficient. We can find what this covariance, and using this co-VER, then we can find what the delta co-VER. One thing here is what you find what there is no any what we don't include any macro variables. This model we call static model. Okay, this is what just talking about we are assuming the whole system is what not dynamic. But unfortunately, in the real economy, if you are using this way to estimate this, we call a systemic risk, may be misleading. That's why in 2011, A and B, they modified this approach by including what a set of macro variables they call state variables. Okay, state variable to control for non-systematic market-specific risk. So in this case, you see in the difference between the previous slide and this slide is what we are including the gamma term, the what the macro variables. Of course, you can include many as much as possible as long as you can collect the data if there is no enough data available. But how many data we can include? It depends on the what data availability. So now you can see what. So the equation is exactly same. The only thing we are just adding the what m term, but the last equation what same. Okay, same. So this is how we measure the systemic risk. Okay, systemic risk. Okay, let's see what's the result. Okay, let's result. Of course, we collect data of the stock market from Malaysia from 25 July 2005 to December 31st, 2017. And of course, in Malaysia, we have what? 18 Islamic banks, plus many what? Commercial banks. Unfortunately, what? Due to the data, we only can able to include one Islamic banks. Initially, I'm so excited because what? Given so many banks, I can include as much as banks in the slide so that what? To make the study more fantastic. Unfortunately, what? Only one bank is actually, and of course, commercial banks say I only can have 5 commercial bank plus 1 Islamic bank. We call what? Bank Islam. And of course, about state variables, I only can include 3 variables. Okay, what's the market volatility, yield spread, and what's the difference between the 10 years government bond and what 3 months T-bills? Because I include this one, try to what we capture the investment sentiments and the trend and what expectation of the future of the system. Okay, the economy. So this is the 6 banks profile of 6 banks. You can see the total asset of 6 banks. Okay, May Bank or Malayan Bank is the biggest, and the Islamic Bank is the smallest. Okay, smallest bank is Malaysia. So this is what the summary statistics of the log return for all the banks we are included. You can see the mean return only public bank a little higher, others are not so much difference. Okay, you can see even the what how fluctuates this return is. Okay, you can see here Bank Islam is what most volatile. Okay, the Bank Islam is what most volatile. You can the return can up to -15 up to 29%. Okay, other banks, and again of course it's CIMB also a little bit what volatile. Okay, volatile. Okay, now let's do the first estimation about the non-dynamic, okay, or we call what? Static of the value at risk and core value at risk, and what? The delta at risk for each bank. So we have three, for every bank we have three data. From this people, what we can say, okay, Bank Islam as a person, individually was their highest what? Value at risk means what? Individually, Bank Islam is the most risky bank. You can see from here, which is what some of us are not happy with this result, because how come Islamic bank become more risky? But unfortunately, the data speaks. I'm not speaking myself. Okay, so you can see the 5.32 is what? The highest value at risk. Okay, value risk. And then we can see the second 3.47 is what? Is what? The core, what we call the core variance between the Islamic bank and the financial system. And you can see here 0.95 is what? Islamic bank, which contribute the least to the overall system risk. Even individually, Bank Islam is very risky, but they contribute the less to the financial system. Okay, I'm sure Fazan will be happy, am I right? Okay, good. Okay, but you can see other the bank are what? More or less something like this. Okay, now, so as we just mentioned, what this this one does not take into the macro condition into what? General macro condition into consideration. That's why we have to include the macro variables and to estimate what? Dynamics of this covariance, core what? Value at risk. You can see here different color for different bank. Here what you see, the Bank Islam Islam becomes the what? Highest in terms of what? We call what? Conditional value at risk. And the Mi Bank is what? The smallest. Okay, smallest. It means what? From here, Bank Islam is the most risky bank among all other banks when we are talking about that, the macro variable or into consideration. And we also can see what? In the global financial crisis period, all the banks become more risky, or they are respond very what? Related to the general. So next one is what? Because what? This is VAR value. Okay, if you want to make the value at risk to be more reliable or accurate, you have to do the back testing. So for this, we have done the back testing using this QPs in 95 and what? Unconditional convergence test, and what? This Christopher joint test 1998. And from this table we can see what? The upper one is for the unconditional coverage test. The lower part is for this what? Joint test. And both tests means what? Our WAR model is what? Fine. There's no issues. Okay, so we can proceed for the next step. So this one actually was a conditional delta core VAR. This one actually was what we are trying to find out for this paper. So how much each bank contribute to the financial crisis or systemic risk? You can see from here, the first part actually what refers to the financial crisis time. See, every bank, they drop. What means drop? The contribution to the system risk because increasing in the financial. But immediately after this crisis, all become less. Okay, all become less. You can see here. The only thing was the Hong Kong Bank is what? Very calm. They are not responding too much. Okay, you can see our Islamic Bank is very deep and also what? A jump up again. Okay, jump up again. And from this table also you can see what? This Bank Islam actually is the most contributor to the systemic risk. Okay, systemic risk. When we are talking about what? When we are taking all the macro condition into consideration. How to explain this one? Because what we are taught, Islamic bank, because due to the nature, about low leverage ratios, okay, real economy, they should be more stable. I think this due to the concept. Okay, individual bank stable does not mean what? They are not going to contribute more to the overall system. Okay, system. So now let's again, okay. Next one is what? We want to test the link among the banks, okay, link among banks. So from here you can see, okay, how to introduce this table. Anything on the, what we call the roll is when the bank on trouble. In the column is what the bank was impacted. That can be example here. When public bank in trouble, CIMB, the value at risk what? We increase by 4.05. It means what? Or when the Bank Islam in trouble, CIMB bank going to increase by what? The problem also increase by 3.73. This talking about what? The how the bank affect each other. Here is very interesting thing. We can find what? All the bank, they have what? Greater impact on Bank Islam. Can you see the last row? It means whether CIM bank or public bank, bank, they all have what? The highest impact on Islamic bank. This is we feel a little bit what? Surprising. Okay, surprising. Why? Because from the previous table we see what? The size matters. The size matters. You can see here. Let's go back to this this table. Okay, sorry. You can see here. BIMB is what? The smallest bank of this world, all banks. So that's why I see what for the time being, because what I have not run any regression on the factor behind this. Any factors behind this, that's why what I cannot see. That I only can see what maybe size is a issue. Well, we don't know yet. Okay, so it is what this one we need to find out what more data to do it. Unfortunately, what because to collecting data is not easy, so I cannot run this one. But anyway, for what we do the study, am I right? Why we should do the study? Of course, for regulation purpose. Am I right? So we want to know whether this study could be used regulation what purpose, or can be used as what base for regulation. Unfortunately, what this delta core VAR is what highly frequency measure of tail risk is not easy to what to use for policy recommendation. Okay, and also what you see when we are estimating this one, we are using what backward. Okay, backward what we call we are using what history data. So it is what is backward looking. Maximum sometime maybe what recent data. Another what, and also from this graph you can see what this all the whether it's value at risk or COVER, they all have what polycyclical problems, which is what not good for the policy recommendation. So the only so for one possibility is what let's determine that to test what are the factors which contribute to the what systematic risk. So that's why we try to estimate the relation between the delta core VNR and the low. I'm sorry, the L is missing. Where is L? Low frequency, easily observable institution specific variables such as what size of the institution, leverage ratio, maturity mismatch, or size of what some institution. So based on this one, I what this one maybe you can have certain what policy what implication. Given this in mind, I recollected what some other data which is what available. So we have, of course, the VER we already estimated. The leverage, okay, this leverage what is a special leverage. This is based on the Basel III, the tier 1 cap to over the total exposure. It means what the total asset plus the non-balance sheet asset. This is what we call a leverage ratio. So this leverage ratio what? The higher this ratio, it means what? We have a higher core capital, which is what? The institution become less risky because they have more capacity to resist to the risk. MTB is what? Market to book ratio, market value to the book value ratio, and the log B is what? This book equity. It is what? This is to to proxy the size of the bank. And of course, weekly return, because we already have this one. And maturity mismatch, we also have the data. So this is what we run we call the panel data regression. We get this table, okay? You can see 1 quarter, 6 months, and 1 year. What does it mean? So we regress the delta core VAR for future data, okay? After say 1 quarter or 6 months or 1 year. So it means this is what we try to turn the backward into forward looking, okay? Forward looking. So from here, I just give you one example. Okay, do we have this one? No. You can see here, I put the 0.224, okay? 0.224, what does it mean? If the size of the bank, this is log, if the log size of the bank increased by 1 unit, what happened to this systematic risk? The systematic risk will increase by 0.224, okay, 0.224. So the dependent variable is delta COVAR, which is in negative. So negative and negative what? They are positively correlated. So from here you can see only the leverage is positive, others all what? Negative is what? The higher the leverage ratio, the lower the systemic risk. Others are actually what? All enhancing the systematic risk. So this is what? Combined with the general knowledge, okay? General knowledge. So how to use this one, okay? Can we use this one as a stress testing? Yes, okay. This one we can use as what? For stress testing. Assume bank A, bank B shares everything same. They are almost same, identical. The only difference is what? They have different leverage ratio and also different what? Bank size. Okay, bank size. If the bank A is 10 times bigger than what? Bank B, then based on the estimation in the previous table, we can see what? Bank A's systemic contribution will increase in next quarter by 0.0224. Okay, 0.224. What's the implication? What's the implication of this? So based on the Basel III, to meet the minimum capital requirement as for Basel III, the macro regulation requires, okay? Alama, this something is there, okay? Okay, to make this bank A and bank B have similar systemic risk contribution, you have to what? Inject capital to bank A. By how many percent? 6.9%. How we get the 6.9%? Okay, accounting, okay. Actually, what is very easy, okay? 0.224 divided by 3.25. This is accounting equation. Through accounting, we can find this equals to what? 6.9. So, in this case, if the core capital of bank is now 300 million, if you want to make A to be equal system risk with bank B, you have to re-inject 20.7 billion, okay, additional capital to make sure both banks have similar system risk. So this is one application of these studies. And of course, maybe you can interpret other variables. For example, what these others, okay, you can interpret it. But now I just give you one, okay, one application. So finally, let's come to the conclusion. Okay. So from what we have so far done is actually what we have evaluated the systematic risk in Malaysian banking sector using the A and B approach. Okay. And of course, in estimating this one, we have used a quantile regression. Okay, two estimate there. This is not T, only two. Okay, and of course, we have to validate our procedure by backtesting. Okay, and we also evaluated every individual risk, core risk, and plus what? Systematic risk for every banks. And of course, we also have what? Done a preliminary application of system risk, illustrated what? For stress testing. Okay, stress testing. Okay, unfortunately, okay, so next, okay, this is only very preliminary result because what? We only have 6 banks. to generalize the result is not fair. So it's important for us to include more banks, more what maybe scope of the research must be increased, and also what maybe have more what macro variables to be included, okay, included. And the interesting is what Islamic bank tend to be more risky, and also tend to be what contribute more to the system risk when the macro condition is what taken into consideration. How to explain this one? Okay, how to explain this one? So we need to do another what panel regression. Okay, panel regression. We have to find what are the factors. We have to find all this what bank specific data and see regress between the system risk and the bank specific factors. Then we can answer the question. For the time being, even I have my answer, I did not to what speak it because I'm afraid if we give you wrong interpretation. Okay, so after we done this next research, next studies, then maybe we answer the question. Okay. So, and also we find what the interdependence among the banks in Malaysia is very strong. So it means the macro regulation is very important to make sure none of the bank left behind in terms of what regulation. So by this, I would like to say thank you to all of you for your attention.
Thank you, Dr. Tarkan, for your informative presentation. Now we open the floor for any question or comments. تفضل.
First of all, I would like to record my appreciation on the presentation. I'm happy to know that the topic is more on taking Malaysian banking as an example rather than Islamic banking in Malaysia, because the conclusion that you have made and also the observation, which somehow I think would have contributed to negative impression that Islamic banking is risky. I would say that if you want to go to that conclusion, it wouldn't be fair based on the sample. If Bank Islam is there, you should put all the subsidiaries. Can you go to the list of banks? All subsidiaries of those banks, the Islamic subsidiary, there it would be fair. For example, rather you go for Maybank as a banking group, you should go compare Bank Islam and Maybank Islamic, because all of them have their subsidiaries. That is number one. Number two, have you while doing this research taking into the consideration the condition of Bank Islam at that moment? Do you know that at that moment, that period of time, they were facing 450 million US dollar issue of default by their loved one branch that leads to the whole management of Bank Islam having restructuring exercise. Lead to the appointment of the new CEO or managing director. That's the currently So one, and to have the conclusion as well as observation based on the sampling of Bank Islam alone, which at that time was having issues, many issues. I would rather you to draw the conclusion on Islamic banking into this. Unless you decide to take all the subsidiaries, all the 5 banking group on their Islamic subsidiaries with Bank Islam. Nonetheless, still, Bank Islam is not at par at that moment. Unless you are taking Bank Islam today compared to them. Because now, if you notice on even the current asset of Bank Islam compared to other conventional banks, even Bank Islam ranking, I think it's the second, third of all major banks in Malaysia.
Can I respond?
You will take one by one.
Oh, yeah. Okay. Okay. Thank you, brother Fazlan. Okay. What you see is actually correct. As I just mentioned, okay, I cannot do any generalization of the result because it's not fair, as I mentioned just now. See what? Due to the data availability, this is not fair to see. And the second, you see what? Are you taking care of this what? The Bank Islam at that moment? I try to make sure myself is neutral. Okay, I just want the data to see what happened at that time. So, fortunately or unfortunately, my result confines to what you express just now. Okay, Bank Islam have a problem. That's why they are giving these issues. So I try to not read some because normally when we come to the policy implication, then we may read what happened to them. But now up to this stage, I'm just asking the data tell the story without my any personal or what we call emotional input inside it. Okay, that's why I say there's no generalization. You are right. Actually, I also want to put more banks. Unfortunately, most of them I cannot find the listed stock market data, and difficult because actually I have asked my friends in Malaysia in different parts to help us. Finally, they only can up to this stage. Okay, thank you.
طيب تفضل.
Thank you very much. I just have one observation. Of course, the issue raised by our colleague here is a bad issue. But my first question is certainly taken. Does this mean you could not find more than, if you look at the stock, if I understand you just look at the market is listed in stock markets. Am I right? And you cannot find any other bank. You say 18 banks there to use for this. It's one Islam bank in the list. And that also makes another question. Data. I didn't see any time here. Data was, number of years, where now you actually have a conclusion very conservative. Even though you say I don't answer, but I'm not going to discuss. But right. This will go into the market, and the impression everybody will get during the people here, Islamic banks, or Islamic financial system is more risky than conventional. Will that confront you with the history what happened 7-8 years ago? How do you reconcile these two things where at that time Islamic banks were less in terms of assets, in terms of financial availability, the service they give, and that was a global issue. And today, to me, this study, I don't know, I don't want to hear say more than this, but when you look at Malaysia and you bring this to us here today, it creates a lot of black. What I'm going to conclude in terms of the availability of the data, if that's the question, then I have another question. Thank you very much.
Okay, brother. Okay, thank you for your question. Actually, please take note that what I never say this is a generalization. I have emphasized in my presentation. As per this study, given the data available for the time being, that's the result. This does not say all the Islam banks are risky or they contribute more to the systemic risk. Okay, I'm not saying that one. Maybe due for that data coverage period, it looks like this. Or maybe was what? Maybe due to the data we collected from this website or from this database. Maybe have something wrong with data, which is what is beyond my capacity to validate that data. Because of course all the data actually officially come, not from my own. It's all official from the Malaysian relevant authorities. This data coming from, not from me. Okay, but again, I have to emphasize that I'm not generalizing. Islamic banks are risky. I just say, based on this study, for this sample data, I can see that at that moment, the Islamic banks seems are risky and contribute more to the systematic risk. That's all. Okay, I don't want to see bad. I don't want to see good. I am neutral now. Yes.
دكتور أيمن تفضل.
Thank you. I think we all like the energy so passionate. I have one question.
Okay.
I recall that the IFSP in 2015, one of the documents, in fact, it was an IFSP strategy report. It says for a financial system to be having a systemic risk, it has to be considered to be systematically important.
Okay.
And to be having systematically importance, then according to IFSP estimation, obviously, the system should have at least 20% of other financial assets. Now, the question is that, and Malaysia is considered as having systemic importance. With respect to your empirical research, you took the 6 banks as the samples. Do these 6 banks make up for at least 20% to be having systemic importance in your definitions as having systemic risk? This is my question.
Okay.
Second, did you, when you did the estimation, did you differentiate between fully fledged and having been built a subsidiary? Because it may have, obviously, you are the economy.
Okay.
And third, in one of the pages, it says clearly that the estimation is based on tail correlation on equity returns. One thing that's quite puzzling for me, and I think you rightly highlighted, and as we all know that the bar, whether you call it conditional bar or adjusted and so on and so forth, bar is essentially dealing with Gaussian distribution. It does not necessarily deal with Taylor distribution. Whereas, and when there is something happening with the Gaussian distribution, it is from the theory, it says that it can be handled by the expected losses. So it does not necessarily have this worse or significant contagious effect when it happens. So fourth, my last question. With respect to the leverage ratio increasing by 6.9%, I think it was one of the stages. Does it suggest the type of capital in the context of Basel III that can be deployed in the event of going concern and gone concern? Because this is also one of the distinguishing features in Basel III as compared to the previous Basel I.
Okay. First, for about the systematically important institution in any economy, based on FSPC, must have a 20%. Okay, 20% of the overall shares. Okay, but that concept and the concept I'm using in these studies are totally different concepts. Okay, in IRSB, when they see that the systemic importance was the share of Islamic asset over the total asset, right? That's we call the share of the Islamic asset in the total market. That's we call that's IFSP concept. In our case, when we see systematically important, it means what? Not necessarily means what? The asset itself. We are talking about whether this bank is important enough to affect the whole system when this bank in trouble. This is totally different concept. Okay, that's talking about only share without talking about what's impact of that share to the overall system when one or two of this bank have problem. That's a different concept. Second, about when you're asking for whether I consider full-fledged or what is a substrate. Yes, I try to do that one. Unfortunately, no enough sufficient data to be employed. That's why I have to reward aggregate. Maybank, I don't care whether you are. Of course, that's why there may be some mix. That's a mix. Okay. Number 3 about this value at risk. Okay, I know because value at risk is we can say in different ways. Okay, different ways. And here I'm just using what is a stats approach, given the what proper definition of valuation. I try to run it. I get a result without any my personal judgment. Okay, judgment. And I use the quantile regression to get the value at risk. Is one reason is try to avoid the specificity of the distribution property of the return, because value at risk is what? Very much influenced by how the data distribution looks like, am I right? Whether it's a normal distribution or gamma distribution or student distribution, it will affect. But to avoid this one, I use a contact regression, which is what? Because I explore all these issues. The last question about the leverage issue, because Basel III, we mentioned what? Initially, the difference between Basel III and the Basel I and II is what? They come up with a new requirement, the leverage ratio, which is the Tier 1 over what? It's all total asset exposure plus off balance sheet asset. Okay, here I'm using this leverage ratio. So that what? Normally, now they request this one actually to be 3%, right? This one's the minimum requirement to be 3%. If I'm not mistaken, 3%. Whatever, okay, let's see. We'll check this book. So, the higher the ratio, it means the bank or the institution have more capacity to resist to any shortage of capital, so that they can avoid any shortcoming. So when this what you see just now. Okay, when the bank size increase, because the size actually talking about what? The size could be the asset, balance sheet asset plus what? Off balance sheet asset. This maybe both increase. Okay, increase. Used to this off balance sheet was not considered, but now if the size of the bank increased by 5 times or 10 times, okay, 10 times. So to maintain the minimum requirement of that 3% whatever, you have to top up this word. Something is a numerator, right? Numerator. So that's why. Based on this one, of course, we use a accounting equation. We can find. Okay, so this the leverage ratio divide by this one. No, what is what we call this 0.225. Okay, the size ratio divide by the what leverage ratio equivalent to the additional capital we need. That's why we come out with a 6.9%. Okay, 6.9%. So when you see this one, okay, whether this we are talking about here is core capital. We need to increase the core capital, the Tier 1 capital, not other capitals. Okay, thank you.
تفضل دكتور بعدين دكتور عثمان because he is leaving can I take Dr. Athman first.
Very short question, and I don't anything about that. At macro level, I mean, the impact of, for example, public policies, regulatory policies, and other policies of the of the governments. It seems that the whole exercise or analysis is at micro level, maybe, but at macro level, and I don't see the presentation, although I didn't see from the beginning anything. Well, what are the explanations of this systemic risk in Malaysian banking system, given the public policy and macroeconomic variables? Second, what is the contagion? Yeah, what extent risk to transfer among Malaysian banks? What is the likelihood of that? This cannot back will be go through the system to the other bank. Thank you.
Okay, if I'm not taking wrongly what you're asking, okay, what you asked actually, because there's another branch of the quantification of the likelihood of a financial the systemic risk, okay, to using this probability kind of thing. They also have maybe more than 15 types of way to study whether there is a likelihood of the financial crisis or something like this. But my study actually what is different with that
Thank you, Dr. Burhan. Excellent presentation. For me, to have like refresh on quantitative methods class. But question is more on the systemic risk. Are you considering non-banking financial institutions to have contribution to the systemic risk? That's the first question. The second question is, you mentioned that this is the initial study. What's next, and what is the further operations in terms of how to measure the systemic risk itself? And are you considering other countries as well to be included in the study? And the third one is, it's more on general observation, because I'm a commercial banker. You mentioned on your presentation that the size does matter. Yes, because the individual bank with lesser assets tend to enter the so-called riskier market than the bank that is having more, or in terms of the size of the bank is higher than the. So maybe if you can look at it from that perspective as well. Yeah, I think that's all. Thank you very much. I think I will pick up from just where you I think small opinions just quite I look at yeah, it looks like you have an ROI. I think if you look at the correlation, you can say that the bank, that bank, the bank that has a lot more. But the look at the correlation, society is run on both sides. So you can society is run on both sides. So you at the beginning of the presentation, you also talked about it would be the ability of people for providing it is that from 2005 to 2007. And within that time, you have had 2007.
So these are just comments.